Hi traders, welcome to this Beginners Academy video, part 3. In this video, we discuss the popular indicators, the Fibonacci retracement tool, and the moving averages. The Fibonacci retracement tool is a popular tool among Forex traders. It is based on the key numbers identified by mathematician Leonardo Fibonacci in the 13th century. Fibonacci's sequence of numbers is not as important as the mathematical relationships expressed as ratios between the numbers in the series. In technical analysis, Fibonacci retracement is created by taking two extreme points, usually a major high and low, on a Forex chart and dividing the vertical distance by the key Fibonacci ratios of 23.6, 38.2, 50, 61.8 and 100. Once these levels are identified, horizontal lines are drawn and used to identify possible support and resistance levels. If a price retraces to, for example, the 38.2 level, then bounces off, this level becomes a potential support or resistance. Traders can also use these levels to determine entry or exit points. For instance, if the market retraces to a fib level, like the 61.8, and then starts to show signs of a reversal, traders might use that as a buying or selling opportunity. Beyond the retracements, Fibonacci extensions can also be used. These project how far the price might move past the price range of the analysed period. Common extensions levels are the 127.2 and the 161.8. Like all trading tools, Fibonacci retracement levels are best used in conjunction with other forms of technical analysis. For instance, combining Fibonacci levels with candlestick patterns. Moving averages are another popular tool of technical analysis, not just in Forex but across numerous financial markets. They are used to identify trends, generate potential buy and sell signals, and assess market momentum. At their core, moving averages help smooth out price data, creating a single flowing line, which makes it easier to identify the direction of a trend. The most common type of moving average is the SMA, or the simple moving average. The SMA is calculated by adding together the closing price of a currency pair for a set number of time periods and then dividing this total by the same number of time periods. For example, the 50-day SMA adds up the closing prices of the last 50 days and divides it by 50. The EMA, or the exponential moving average, places more weight on the most recent prices, and as such it responds more quickly to price change than the SMA. This is particularly useful for traders who rely on quick trades. As you can see on the visuals here, the SMA is the yellow line and the EMA is the red line. You can see that the EMA reacts to price a little bit more quickly than the SMA and isn't as smooth as the SMA. When the price of currency pair is moving above the moving average, it indicates that the trend might be upward. When it is below, it suggests that the potential downtrend is apparent. If the moving averages are flowing between each other, it could point out a range. MAs can act as dynamic levels of support and resistance. For instance, during a downtrend, a moving average might serve as a resistance level where price tends to bounce. The distance between the price and its moving average can indicate momentum. If the price is significantly above the MA, the market might be overbought. Conversely, if it's well below the MA, it might be oversold. In summary, in this video we learned about the Fibonacci tool, we learned about Fibonacci retracements and extensions, we also learned about moving averages, the SMA and the EMA. We also showed you how it can be used as a dynamic support and resistance. Thanks for watching the Academy Beginners Part 3. Thank you, and I'll see you in the next one.